$350 billion every single day. That's how much is being settled on a blockchain most people have never even heard of. And the names behind it? Goldman Sachs, Bank of America, Citadel Securities, DTCC. Meanwhile, a 336-year-old British bank just started shopping for a blockchain settlement engine, and Citi and Morgan Stanley are building crypto custody for $38 trillion in combined assets. Yeah, the financial system is being rebuilt right now. And today, I'm going to show you exactly how. Okay, so here's a question. If you ask most people in crypto to name the biggest blockchain by actual institutional usage, they'd probably say Ethereum, maybe Solana. But the real answer? It's Canton. And unless you're deep in institutional finance, you've probably never heard of it. Canton is a privacy-enabled Layer 1 blockchain built by Digital Asset, founded by a former Citadel algorithmic trader named Yuval Ruse. Launched in 2023 with Goldman Sachs, BNP Paribas, Deutsche Börse, Cboe, Deloitte, and Paxos. And here's what makes Canton different from every enterprise blockchain before it. Remember Hyperledger, R3 Corda? Those solved privacy but created silos. Your Goldman ledger couldn't talk to your BNY ledger. Canton fixes this with something called the Global Synchronizer, atomic cross-domain settlement, where multi-leg transactions either fully succeed or fully fail across separate institutional environments, without anyone seeing each other's data. The numbers are staggering. Over 600 institutional participants, 575 validators, 3 million transactions daily, and Broadridge's repo platform on Canton processes roughly $350 billion a day, 3% of the entire US repo market, on a blockchain, right now. In December, DTCC partnered with Digital Asset to tokenize US Treasury securities on Canton, got a no-action letter from the SEC. MVP launches first half of this year. Last August, Bank of America, Citadel Securities, and TradeWeb completed the first ever fully on-chain US Treasury financing on a Saturday. 24/7 institutional settlement is real. Now the skeptics have a point. The validators are basically the same banks the network serves. Goldman, Citadel, and DTCC are simultaneously investors, validators, and users. And $6 trillion in tokenized assets on chain, but only a $6.5 billion market cap. That's a weird disconnect. But here's what nobody talks about. Under Basel Accords, public blockchain assets face a 1,250% risk weighting. Canton's selective transparency qualifies as Group 1 exposures, avoiding those punitive capital charges entirely. Follow the regulatory capital math, and you'll understand why banks chose Canton. Okay, before I get into the Barclays story, I want to know what you think. We just covered a blockchain that's already settling $350 billion a day for Goldman Sachs and Citadel. And most people in crypto haven't even heard of it. Does that change how you think about where institutional adoption is actually happening? Drop your take in the comments. Because what I'm about to cover next might change your mind. So Canton is the invisible infrastructure layer. But what happens when traditional banks decide they need their own blockchain engines? That brings us to something Bloomberg reported yesterday that flew under the radar. Barclays, $2.2 trillion in total assets, 336 years old, founded in 1690, just issued requests for information to technology providers to build a blockchain-based platform for payments, stablecoins, and tokenized deposits. And here's what makes this more than just another bank exploring blockchain. Vendor selection could come as early as April. That's not a research initiative. That's a procurement timeline. And Barclays has been building toward this moment for over a decade. Back in 2016, they partnered with a startup called Wave to complete the world's first blockchain-based trade finance transaction, a letter of credit that cut processing from 7 to 10 days down to under 4 hours. They joined the R3 consortium. They participated in the UK's regulated liability network. But the real signal came in January. Barclays made its first ever direct digital asset investment, a stake in Ubix, a stablecoin clearing startup founded by Tony McLaughlin, a 20-year Citi veteran who literally architected the regulated liability network. Ubix is backed by Galaxy Ventures, Coinbase Ventures, Peter Thiel's Founders Fund, and Paxos. And they already have Ripple, Paxos, and Monerium as stablecoin issuers signed on. So Barclays invested in the clearing layer first, then 2 months later started procurement for the settlement engine itself. That's a two-pronged strategy. But here's the uncomfortable truth. JP Morgan has a 7-year head start. Connexus has processed over $1.5 trillion since 2020. They average more than $2 billion a day. HSBC Orion has enabled over $3.5 billion in digitally native bonds. And then there's the cautionary tale. The Australian Securities Exchange spent 7 years and $250 million trying to build blockchain settlement and scrapped the entire thing in 2022. The regulator sued them. So can Barclays close a 7-year gap fast enough to matter? I don't know. But with the stablecoin market projected to hit $1 trillion by late this year, and 6 UK banks already piloting tokenized sterling deposits together, Barclays may not have the luxury of waiting. And that brings us to the biggest names in the room. Citi and Morgan Stanley both dropped major crypto infrastructure announcements this week, and together they represent $38 trillion in combined assets building native blockchain rails. Let's start with Citi. $30 trillion in client assets under their security services, launching institutional Bitcoin custody later this year. Their head of digital asset custody, Nisha Surendran, put it perfectly. Quote, "Clients don't want to handle wallets and keys and one-time addresses. They want exposure to Bitcoin within familiar banking systems." End quote. So what does that look like? A single safekeeping account combining Bitcoin, securities, and cash. Cross-margining between digital and traditional assets. Transaction instructions via SWIFT, not seed phrases. Bitcoin positions in the same tax workflows as equities. They've been building this internally for 2 to 3 years, and Citi Token Services is already live in the US and Singapore for 24/7 blockchain-based money movement. Now Morgan Stanley, $8 trillion in assets. E-Trade crypto trading launching first half of this year. Bitcoin, Ethereum, and Solana. They filed for an OCC National Trust Bank charter for Morgan Stanley Digital Trust. And their head of digital asset strategy, Amy Oldenburg, said, quote, "We really need to build this out internally. We can't just primarily rent the technology," end quote. That's Morgan Stanley saying third-party custody isn't good enough. They're starting with zero hash, then later this year, ending that partnership to run everything on their own infrastructure. Now the irony is thick. Bitcoin was created to eliminate trusted third parties, and now these banks want to be the trusted third parties. Meanwhile, Jamie Dimon at JP Morgan still refuses to custody crypto. So there's no Wall Street consensus. But here's the bigger picture. Citi just joined a 9 bank consortium with Goldman Sachs, Deutsche Bank, and UBS to develop jointly backed stablecoins for G7 currencies, the largest bank backed digital currency initiative in history. And hedge fund crypto exposure hit 55% last year, 71% plan to increase. The demand is pulling the banks in, not the other way around. So here's what I keep coming back to. Canton is already processing 3% of the entire US repo market on chain. With Goldman, Bank of America, and DTCC, Barclays is moving from a decade of research into actual procurement. Vendor selection in April, and Citi and Morgan Stanley are building native crypto custody and trading infrastructure that touches 38 trillion in combined assets. This isn't the speculative phase anymore. This isn't banks writing white papers or running sandbox experiments. This is production infrastructure, real settlement, real assets, real money. And what's wild is that most of this is happening quietly. No flashy announcements, no token launches, just the plumbing of global finance being rerouted through distributed ledgers, one settlement engine at a time. The question isn't if traditional finance integrates blockchain. That's already happened. The question is whether you noticed. If this breakdown helped you see what's being built behind the headlines, smash that subscribe button and drop a comment. Which bank's crypto move surprised you the most? I read every single one. See you in the next one.